All right. Let me, all right, everybody see my screen okay?
Yeah, the crazy colors. Yep.
Oh, yes. All right, so we're going to talk about DTI today. This is one of the most, if not the most important factor in loan qualification. When you talk about debt to income ratio and the ability to repay, which is on just about every loan since 2010. You hear this figure and this phrase batted around, and I don't know if we actually have a good understanding of what debt to income ratio means. So I wanted to dive in a little bit deeper just so we can fully understand, and as always, ask questions as they come to your mind. First thing I will say is that there's a huge difference between what somebody is approved for and what they're comfortable with. You know, I mean, the biggest thing that I try and develop a comfort level with the buyer about is maybe they're a first-time buyer. What are you paying rent right now? Maybe they're a move-up buyer. What's your mortgage payment right now? What would you be comfortable with? That's especially important in this environment where someone might be trading up a 3.5% rate for a 6.5% rate, right? So a lot of people will say, hey, you know, I just want to see what I'm pre-approved for, and that's fine. But I think going a little bit deeper is super important to get people comfortable with their why. Why are you moving? What kind of payment do you want? You know, we're a payment-driven society. And I think that getting people comfortable with that monthly figure for the next 3 or 5 or 7 or 17 or 27 years of their life is important. A reminder before we dive into debt to income, there are 4 different elements of the loan approval process, right? So there is credit, there's income, assets, and property. So for discussion today, we're just going to talk about income and specifically debt to income ratio. So what is DTI? DTI is all of your monthly debt payments divided by your gross monthly income. This is a way that lenders can essentially determine your ability to make payments and repay the money that you anticipate borrowing, okay? So to see this in action, we need to see real numbers on a page. All right, let's say we've got a $90,000 a year job. Let's say it's just one borrower. That's $7,500 a month. Very important that you understand that gross income or pre-tax income is always what's used to determine a borrower's debt to income ratio. So somebody says, my take-home pay is this. Well, that's great, and I'm glad that you're calculating your budget on your take-home pay, but lenders will always use the gross income for qualifying and calculating your DTI. All right, so we got somebody that's making $90,000 a year, $7,500 a month. They've got a new mortgage payment of $2,500. They got a car loan that's $500 a month. They've got $30,000 in student loans, and they have $100 that they pay minimum payments on to a couple of credit cards. It's important to note that there are 2 different parts of the debt to income ratio. There's the housing ratio, which is principal and interest, taxes, insurance, and HOA dues, right? Divided by your gross income. So again, we've got a new mortgage payment that's $2,500. They make $7,500 per month. They have a 33% housing ratio. The housing ratio is one part of the DTI. It just basically says, okay, how much is the mortgage payment versus their income? In this calculation, it's 1/3. The second part of the DTI calculation is total ratio. That's where you factor in all the other debts that somebody has. All right, so we got a $2,500 mortgage payment, but we've got that car for $500 a month. $30,000 in student loans, you use 1/2 of 1% to calculate what that factors for the DTI. So 1/2 of 1% of 30K is $150 a month. Got the credit card minimums that are $100. All right, so all said and done, they've got 700 and why is my math not working? $750 in liabilities outside of the mortgage. So that would be $3,250 once you add everything together, the new mortgage plus all the debts, and that would create a back end debt to income ratio of 43%. So you would have a 33% front end and a 43% back end. Does that calculation make sense to you all? Any questions on that?
It does. And on an FHA, it's 56%. Is that right?
Let's talk about those maximum debt to income ratios. Excellent segue. You are right. So the maximum that the mortgage payment can be is 46.99% for FHA. All right. So if you go back to this example, you've got somebody that's making $90,000 a year, and they make $7,500 a month. Their mortgage cannot exceed 35.25, right? Their mortgage cannot exceed 47% of their gross income. But Josh, the back end ratio is 57%. Okay, so that's factoring in all of those debts. A lot of people say, FHA is a great product. FHA is coming back. We've got lower PMI on FHA loans. FHA also is, a very flexible product for credit and very flexible for DTIs. You'll notice the next line item below, conventional only goes to 50.5%. So that extra 5.5% that FHA allows you, you can qualify for more with FHA. Okay. So 47.57 FHA, conventional is going to max out at 50.5% for both the mortgage payment and the total ratio. So let's say you had somebody that came in and had absolutely zero debt and really good credit. They could essentially qualify with a mortgage payment that is 50% of their gross monthly income. VA limit does not exist. There are no maximum DTI requirements for VA loans. Josh has one closing this week. I don't know if they checked with other lenders, but other lenders would immediately tell them no, because they all have investor caps on what they can do for DTI. VA, I closed a VA loan where the borrower was, getting support from their spouse, but the spouse wasn't on the loan. I was comfortable with it. And, it was north of 60%. So VA is a great product because VA truly will allow you to qualify for the most, with, of course, 0% down if you want to go that route and no PMI. And then USDA is going to be tighter. USDA is 0% down. They figure, okay, that's fine, but you have to be 32% on the front end and 44% on the back end. So you think about it, FHA and VA are pretty flexible on their debt to income ratios. Conventional is pretty good. USDA is the tightest. Any questions on these maximum DTIs? Cool. All right. Let's talk about another wrinkle. So one thing I want to mention here is that just because...
Wait, Colin, I do have
Yeah.
a question. Sorry,
Yes,
I
ma'am.
couldn't unmute. What
Go like
do
this.
you do? Like, how do you... It's Amy.
Yes, go ahead.
Can you calculate, how do you guys determine when someone is paid in commission like we are?
Well, you're technically self-employed, right? So self-employed borrowers, depending on, and we had a different training on this, self-employed borrowers, you will have them submit the most recent 2 tax return years, right? So if your taxes are done for 2022, then you would submit those tax returns. Self-employed borrowers are either going to be sole proprietors, in which you would look at Schedule C, line 31. Here, I wonder if I can do this. Hang on. Okay, you see my screen now?
Not yet. Yes.
Okay. So if you're Schedule C, like for an agent, and we'll do a agent how to qualify training, that might be a good one for next Wednesday. But if you're a sole proprietor, for example, and you're self-employed, a lender is going to take the last 2 tax returns and look at this line 31 and determine, after these write-offs for advertising and car and truck expenses and depletion and depreciation, all that stuff, what is this number? And then divide that by 24. Okay. So, you know, let's say that you had net income of $50,000 in 2021 and $100,000 in 2022. You know, you would have $150,000 in net profit over the last 24 months. And that would be the income that you would use for qualifying. So that's for self-employed Schedule C borrowers.
Perfect. Thank you.
Mm-hmm. You brought up commissions and bonuses and overtime as well. Typically, you want to see at least 1 year, but preferably a 2-year history of receiving what's called variable income, which would be, and then we're talking about W-2 income here, commissions, overtime, bonuses, and that's all averaged over typically a 2-year period. Josh, I know it's important to you. Tips would fall in that category as well. You work with a lot of, restaurant service industry workers. That 2-year history of tip income is important, where you would essentially average over a 2-year period of time. Now, the real question is, how do I get back to where I was? Oh,
Thank you, Colin.
you bet. Okay. Another thing I'll mention is that just because you can determine a maximum DTI, it's not always written in stone. Okay. So, if you've been in this business long enough, you have had issues with lenders where loans have flipped or loans have not been approvable for whatever reason. And so what I will say is, all lenders will run these loans through, once they've calculated debt to income, through an automated underwriting system, Fannie Mae and Freddie Mac, and then, it needs to be approve eligible. So sometimes you will see an FHA loan that is, 50% back end or 45% back end, well within these limits, right? But this system doesn't like it. So, a reminder that just because these are the limits doesn't mean that you're going to be able to get an approval to the maximum of these limits. Because again, there are other elements to a loan approval, right? Somebody with a 610 credit score is probably not going to be able to borrow 56.99%, right? So a lot of that is credit dependent. One thing I'll also mention is that this system here for Fannie Mae and Freddie Mac, this is how appraisal waivers are determined for conventional loans. Lenders will put in an address and then you will see an appraisal waiver spit it out. So just remember that there are multiple factors that are involved in loan approval. And just because somebody is right at the limits, like, yeah, my DTI is great, but there are other things that are involved that might not allow you to go to the absolute max. Let's talk about some tips and tricks. I love this. Everything in lending is just one big problem-solving exercise. No day's the same, and it's fun to just figure out how to get from point A to point B. So let's say that you have a housing ratio is good. Your mortgage payment is low, you know, compared with your overall income, but your total ratio is too high. Okay, you're over, let's say that 50.5% for a conventional loan. I can't get an approval. The mortgage is really a small portion of my overall income, but I have all this other debt. Well, an example would be you just pay off debt to qualify. And you'll see this often done at closing. Let's say you have a $300,000 purchase price, 10% down conventional loan, right? And gosh, it's not giving me an approval. I don't, you know, I'm at 54% back end ratio. I can't be above 50.5%. And homeowners and sometimes real estate agents will say, well, what if you put more down? Before you do that, look at debt that you can pay off for a commensurate amount of the down payment. Okay. So, you know, let's just say that you scaled back to 5% down and use that $15,000 to pay off a car. And there's $400 a month for a car payment that's now paid off, right? That now frees up $400 worth of buying power versus $75 a month. That would be the equivalent if you put that $15,000 down. Okay. This can be used with credit card debt. This can be used with student loans. This can be used with personal loans. Be done with existing mortgages. Okay. So sometimes you just need a little creative thinking to figure out, all right, what's the highest and best use of the money that we have? And can we juggle some numbers around in order to make the debt to income ratios work? Has anybody seen this in action or experienced this or had a borrower that's gone down this route?
Definitely.
Yeah, it's a good strategy. It's something to think about always. All right, and then, you know, all loans have an ability to repay feature. This debt to income ratio is calculated on almost every loan that we do. But there are no ratio loans out there. All right, so Amy, back to your example. You know, I'm a self-employed business owner and I really do not like paying a bunch of taxes. And I think that I probably make more money than what's on my tax returns, right? That's where a bank statement loan comes into play. You know, you can do a non-QM bank statement purchase, refi, cash out refi, investment property loan, where basically you just submit 12 months of your business or personal or both bank statements, and then underwriting will calculate a value based off the rolling balance on your bank statements. You know, they figure that's a better gauge of your income than the traditional Fannie Mae, Freddie Mac income calculation for self-employed borrowers. DSCR, we got a lot of people talking about DSCR lately. DSCR is like, hey, This is a cash flow loan. I'm going to use the rents from this investment property to cover my mortgage. And as long as this property cash flows a little bit, I don't have to submit income docs. I don't have to submit W-2s or pay stubs or K-1s or profit and loss statements. I'm just going to use what's the rent schedule and use that to qualify. And then the last thing I'll say, and Tanner Hagan, I don't think is on this call, but Tanner Hagan has a borrower that has a cash business that doesn't make much money, but wants to move from a multiple living house, which she owns now, to a single level living. And she's like, how am I going to do this? I have good credit, and I have a ton of money in the bank once I sell my house, but I don't qualify for anything. I'm on Social Security disability. There is a 20% down product where all you have to do is put 20% down, have your credit pulled, and then have some reserves in the bank to cover, say, 12 months of mortgage payments. Again, these non-QM loans, guys, are not cocktail party rates. All right, we're not going to be getting 5.99, 30-year fixed on this. But it is a yes where everyone else is telling them no. So something to keep in mind, my DTI is too high. You know, I'm getting rejected at a bunch of other banks. I have a bunch of money down. I have good credit. Non-QM is a way to go to get somebody in, and then perhaps they declare more income next year and refinance into a traditional lower rate conventional product. That's all I have on DTI. Any questions about any of the slides that we covered, y'all? Or anything that you have just been dying, you woke up this morning and said, I cannot wait to ask Colin this question about debt to income ratio.
Colin, it's Sharon Blossom. I have a question. It's sort of on the, okay, so it's not exactly related to this, but when we have, you know, when people are doing appraisal gaps and appraisal waivers, all that sort of thing. Here's what I want to understand. Like, let's say a property is 800,000 and someone's going to put 20% down. What number does the appraisal have to come back at?
Okay, 800,000,
Yeah,
20% down.
right.
So if they want to keep it at 20% down and avoid PMI, it needs to appraise at $800,000 or more, right? But are you asking, you know, what if it appraises at 780?
Yeah, I was likely incorrectly thinking, like on the sell side, if I'm selling something for 800,000 and I want to minimize the risk for my seller, and I was under the impression that, okay, if it's 800,000, they're putting 20% down, we don't have to appraise at 80%. We have to appraise at 80%, 800 minus 20%.
No, so the loan to value is based off the appraised value always. Okay, so if you have a purchase price of 800,000, it needs to appraise at $800,000 or higher. Okay,
Regardless of what the buyer is putting down.
Well, yes and no. Let's just say you appraised at 780, right? Now that borrower can either come up with the 20 grand out of pocket, or maybe they scale back to 15% down with really cheap PMI. So we did a training, Sharon, I'm going to send you a slide deck where we did a training on appraisal gap coverage that I think would really help. And I've got all those slides. I'll send them to you as soon as we get off here.
Okay, thank you.
But let's say that you appraised low, you know, the borrower could say, well, whatever, I'm just gonna do 15% down instead, you know?
And use the other 5% cash to cover the gap.
Sure, exactly.
Okay, but,
Yeah.
okay, so tell me this, because my logic in my brain is struggling with this. Like, so take whatever number scenario, it doesn't matter. Like, let's just say it's $100,000 property, they're putting 20% down, so their loan amount is 80%. I was always under the impression that the appraisal had to cover the bank's investment, which is 80,000.
No, the appraisal needs to match what the purchase price is.
Okay.
Yeah, I kind of follow why you might think that way. But no, the appraised value is the ultimate determining factor in what the loan to value is. So, yeah, I mean, if you appraise light, then, you know, you can work on some different alternatives. But yeah, like in this appraisal gap environment, look, if you have a borrower that's putting 20% down, like, you know, and they have good credit and it appraises at 780, you know, that kind of buyer profile probably has 20 grand laying around, maybe. Or, you know, they go to 15% down, their PMI is $50 a month, you know, and they actually keep some money in their pocket, right? That's an option as well. But I think I'm gonna send that to you as soon as we get off this call, and then we can kind of review some different options, Sharon, for sure.
Okay, thank you.
Especially because I haven't talked to you in forever. You doing all right?
I'm doing great, thanks. Excited for you
Awesome.
to be here. When do you
Yeah.
guys arrive?
June 10th.
All right, not much longer.
Anybody else questions on
Thanks,
anything
Colin.
really? Yeah, you bet. Thank you. Anybody else? "30 minutes on the nose." That's what we shoot for around here. Well, if there's nothing else, I will bid you all adieu and thank you for being here today.
Thanks, Colin. Bye, everybody.